Welcome to this executive briefing. Today, we're going to unpack the sweeping capital gains tax changes enacted right after the autumn 2024 budget. If you're a wealth manager, a trustee, or working with corporate clients, this explainer is designed exactly for you. We're going to dive into how these new rules fundamentally rewrite the playbook for wealth and trust management. Let's get straight to it.
24%. That number is the new, much higher reality for trustee and higher-rate individual capital gains tax. Look, following the October 30th budget, the margin for error in tax planning just vanished overnight. Proactive strategy is absolutely crucial now, because passive portfolio management, that could easily guarantee a 24% tax hit on your gains.
Here is our roadmap for today. First, the new CGT landscape. Second, annual exempt amount limits. Third, trust rules and allocations. Fourth, handling deemed disposals. And fifth, reporting and compliance strategy.
Section 1. The new CGT landscape.
The cost of rebalancing portfolios shifted practically overnight. Before October 30th, standard rates sat comfortably at 10 and 20%. Now, we've got an immediate jump up to 18% for the lower rate and a flat 24% for the higher rate and all trustees. That old math you were using to justify holding or selling an asset in early 2024 is now completely obsolete.
And the pressure really ramps up when we talk about business exits. We're looking at a phased escalation for business asset disposal relief, or BADR, as well as investors' relief. Now, the lifetime limit stays capped at £1 million, but the rate is climbing fast. If an exit happens before April 2025, you keep that 10% rate, but wait until April 2025, it jumps to 14%. By April 2026, it completely aligns with the lower main rate at 18%. This drastically compresses your window for tax-efficient exits. Your corporate clients absolutely need to know that delaying a sale could literally cost them an extra 8% in tax in just a couple of years.
Section 2. Annual exempt amount limits. The era of generous allowances is firmly behind us. For the 2024 to 2025 tax year and rolling right into 2025 and 2026, the annual exemption has totally plummeted. We're looking at just £3,000 for individuals, personal representatives, and trusts for vulnerable or disabled beneficiaries. And for standard trusts, it's a measly £1,500. It's a massive drop when you remember we used to see allowances well over £12,000. It essentially means that almost any meaningful rebalancing of a trust portfolio is going to trigger a taxable event.
Section 3. Trust rules and allocations.
Now, if you are managing multiple settlements, you've got to know the trust fraction rule inside and out. If a single settler has created multiple trusts since June 6, 1978, they don't just hand you that standard £1,500 exemption for each one. Nope, it has to be divided among them. The rules say it's shared equally, capping out at a maximum division of 5 trusts. Also, it's really vital to note that you cannot just transfer the unused annual exemption from one settlement over to another.
And here is the really harsh mathematical reality of that fraction rule. If you manage 5 or more trusts for a single settler, your exemption floor hits an absolute minimum of just £300 per trust. That's the £1,500 maximum divided by 5. £300 leaves you almost zero margin for tax-free gains in a managed portfolio. Literally just minor dividend reinvestments or routine stock sales could push a trust right over this tiny threshold and straight into that 24% bracket.
Section 4. Handling deemed disposals. In trust law, a massive tax event hits when a beneficiary becomes what is called absolutely entitled. This simply means the beneficiary gains the immediate right to take control of the property. This commonly happens when a settlement terminates after a specific term of years, or maybe when a beneficiary hits a contingency age, like their 25th birthday. It also happens upon the death of a life tenant, where the remainder man is suddenly entitled to the capital.
When that absolute entitlement kicks in, boom, you've triggered a deemed disposal for capital gains tax purposes. Now, even though no cash changed hands and nothing was sold on the open market, the tax clock chimes anyway. First, the trustees have to revalue the asset at its current market value. Second, they calculate the trustee's gain based on that new value. And third, they hold the property legally as bare trustees until it is formally transferred. The big takeaway here is that a real tax liability is created purely by an event or the passage of time, so trustees must have the liquidity ready to cover it.
So how do we manage this? We can use holdover relief. Let's look at Jack.
He gives OEIC shares worth £200,000 into a discretionary trust. By jointly electing for holdover relief, the trustees and beneficiaries can transfer the acquisition cost, which brilliantly defers that immediate, heavy tax hit. In Jack's case, he holds over a £50,000 gain. Down the road, when the trustees decide to distribute those funds to the beneficiaries, they can again jointly choose to hold over the gain. That effectively reduces the beneficiary's acquisition cost by the held over amount. It defers the tax until the asset is finally sold, protecting the trust capital right now.
Section 5. Reporting and Compliance Strategy.
When you're doing the math for the 2024 to 2025 transitional tax year, you actually have a really unique planning opportunity. The taxpayer can allocate allowable losses in whatever way is most advantageous to them. It is incredibly beneficial to strategically apply your losses against gains that happened on or after October 30th. Why? Because you want to shield those specific assets from the new 24% rate. You don't want to waste your losses on the earlier gains that were only taxed at 20%. It's a really simple optimization, but it means you need pristine record-keeping of exact disposal dates.
You also need to be crystal clear on exactly when to file a formal return. Trustees must file if the total gross value of the assets disposed of in the year exceeds £50,000, and that's a gross value threshold. Whether you made a profit or a loss doesn't matter. Additionally, you got to report if total chargeable gains simply exceed your newly restricted annual exempt amount, which, as we just saw, could be as low as £300. And finally, you have to file the formally claim an allowable loss or make any other capital gains election, like that holdover relief we just talked about.
Now, here is where actual filings get incredibly complex. When you're dealing with part disposals, let's say selling off a portion of land from a larger estate, you can't just deduct all your original expenses. You must calculate the allowable expenses proportionately using a very strict formula. You multiply your original cost by the value of the part sold, divided by the value of the part sold plus the value of the part kept. Mistakes on this exact formula are one of the most common ways trustees end up with incorrect tax calculations and fully avoidable penalties.
We've covered a ton of ground today, from aggressive rate hikes to slashed exemptions and the tricky mechanics of deemed disposals. Given all of this, the absolutely crucial question you must ask your corporate clients today is this: is your current trust strategy resilient enough to weather this brutal new tax math? Passive management is totally off the table. It's time to review, rebalance with serious intent, and utilize every single relief available. Thank you so much for joining this executive briefing. Now get out there and look at those portfolios.